Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down today's market action, whether you should sell in May and go away. Plus, we'll dig into the market's biggest earnings movers as Eli Lilly slumps after cutting its profit guidance. And we hone in on the state of the consumer and demand for travel as a cautious customer seeks alternatives to traditional vacations. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, you've got your S&P 500 off of its highs of the session, but still up 0.9%. We'll take it. Your tech-heavy NASDAQ lifted by some of those big tech earnings. The M's, Meta and Microsoft, up over 1.5%. Today's the big test for the A's. You've got Apple and Amazon after the bell, but let's flip the board over to the bond market here. You're continuing to see the front end of the curve coming in here. You've got your 10-year below that 4.2 level. The 30-year yield catching just a touch of a lift to the upside when you've got it up about a basis point at the moment. But finally, let's take a look over at Bitcoin. You've got it above that 95,000 level, up 3% this morning. Well, I want to bring in Mark Malik. He's the Chief Investment Officer at Seabrook Financial, an investment firm with $19 billion in assets under management. And Mark, it's great to have you on this morning. It's interesting because if you went away on vacation over the last month, you'd come back and see the NASDAQ 100 was up 1.6%. Does that impact this sell in May, go away narrative? Should people do that still?
That's a good question. There is certainly a thing, the sell in May effect. There are 400 anomalies to the efficient market hypothesis, which says that you can't beat the market because the market has everything factored in. Turns out that the sell in May one is strong enough that people actually do focus on it. But just because it has some statistical significance doesn't mean it always works, right? So in a situation where we've had markets move up and down quite a bit, it's questionable on whether that can be a factor. I mean, this recent move upward certainly might awaken some people who think, oh, maybe better sell, take some profit at this point. Yeah. But on the flip side, a lot of people are probably still sitting on the sidelines with FOMO saying, I don't want to miss this trade. So can it happen? Can it be a seasonal effect? Certainly. But looking at the performance we had last month, which was typically historically much stronger. So you sort of wonder. So that I'd put my money on the fact that it's not going to be a factor this year, although certainly something to watch. It has to be in your model regardless.
And if we do see some of that activity, some of the selling in May, how much anxiety could that cause investors that have already had a really tough couple of weeks here?
Yeah, I think investors are putting on a very brave face. I think underneath the surface, investors are still a little bit antsy and a little bit nervous. I think this last move up, when things move up fast, it's equally as disconcerting as when things move down, especially when you have days like the past few days where markets started out in the doldrums and ended up rallying hard into the close of day like yesterday, just based on a rumor. So I think any of these moves will continue to be accentuated because of the sort of underlying nerves that are still exposed underneath there.
How much conviction can you have in any rally that we get at this moment without a trade negotiation coming along with it?
Yeah, for a long-term focused investor like I am, I can find conviction. I think the big thing for me is to see a sort of sea change in the administration's approach. Now, we still have no agreements. We still have nothing real to look at, but we definitely are witnessing now versus that vacation that you talked about before. Prior to that vacation, you would have seen the administration with its heels dug in. Yeah. But at this point, we see an administration that is at least negotiating. Now the question is how long before we get some real information?
And actually, before we move on, I do want to get your take on tech because I've heard some sources this morning describing to me that the big tech trade, it's so back, and now, who cares about tariffs? Who cares about DeepSeek? How are you thinking about that?
Well, you probably know from our discussions in the past that, the tech trade was never dead for me, right? So, the thing with tech is that the fundamentals are still very, very strong. As I always say, the thesis for those investments still stand. I think what we were lacking for a little bit was, the momentum was completely, let out of the market just because of the systematic pressure, right? The entire market went down. So now that systematic pressure seems like it's easing up up a little bit, and it allows us to look back at the fundamentals. And frankly, trades, earnings like we got last night are certainly going to be helpful. I mean, those are very, very positive earnings, and people were expecting the worst, but they got better than they were expected. So I think these are all positive, very positive signs. Now we just need to see that stuff retrend and then pick up a little bit momentum. It's not so easy because we had such great momentum coming into the end of last year.
Yeah, that is certainly not so easy, Mark. Thank you so much. You're going to be here with us for the hour to continue to provide that context. But let's move on to some breaking news here. We're getting manufacturing data. We also have your ISM and S&P manufacturing data for April coming in line with estimates just above the key 50 level, which separates growth from contraction. The ISM numbers showing economic activity in the manufacturing sector contracting in April for the second month in a row. The reading comes after GDP data on Wednesday showed the U.S. economy contracted in the first quarter for the first time in 3 years. Joining me now, Paul Gruinwald, S&P Global Ratings Global Chief Economist. Paul, great to speak with you. I do want to start on this April manufacturing data here because some interesting things under the hood. Production falling to the lowest level since May of 2020. Prices paid, highest reading since June of 2022. What does that tell you about manufacturing?
Well, it tells me that this process that started with the policy uncertainty and then moved to the markets is now starting to show up in the real data. That's kind of the last leg of this transmission. We had a decent first quarter. Maybe we can talk about that in a minute, but we've been waiting for this to sift into the real economy. The PMIs weak for manufacturing are just signaling that there's probably some weakness on the real side ahead.
And talk to me too about the employment number here rising. There was a little bit of concern this morning when jobless claims came in just a touch higher than anticipated. Yeah. Is this a sign that the employment situation is intact?
That's the critical variable, right? If you go back a couple of years to the inflation scare and the big rise in rates, we've been really focused on this resilience between consumer spending and the labor market. That's held up so far, but if you want to differentiate between the slowdown scenario and the recession scenario, it's going to center on the labor market. So if we start to see cracks in the labor market, that's going to take us into the recession scenario. Not there yet, but we're starting to see a little bit of weakness.
Mm-hmm.
I like to look at these PMI numbers like the business sentiment, just like consumer sentiment is very important for that part of the market.
Yeah.
So the sentiment seems to be pulling down, not surprisingly. The question is how quickly are we going to really start to see this stuff show up in the so-called hard numbers? Although I look at these as hard numbers, but many would call them soft numbers. But for me, firms they do the right thing and they don't have emotions involved. So when I see sentiment starting to drop, I start to get worried. I'm concerned.
Yeah. I think we're with you on that. I mean, it's not kind of a straight line, and you're right. These are soft data because we're not measuring stuff. But certainly, if you're looking at future orders, or this is going to feed into capex or something like that, it's definitely going to move the needle. We know that some of the shipments from China have slowed down dramatically. That's going to take a couple of weeks to work through the system. We know that the financial system's gummed up a bit on M&A and some of the spec grade issuance. So all that's going to take a little bit of time to feed through. But directionally, it's very clear where we're going. It's just a question of how steep the descent's going to be for the rest of the year.
Let's talk about what you just mentioned with regards to China. Obviously, one of our top 3 importers. We had about a 3% pull forward in terms of demand in the GDP data.
Yeah.
When do you anticipate that we might start to see empty shelves because of that pressure?
Yeah, well, there's some stories floating around on timelines. The ships take a while to get from China to here, but the timeline seems to be sometime in the next couple of months. The ships will stop, then the ports will be empty, and then the shelves will be empty, and then we're going to see some of that pressure. The tariff rates on U.S. and China from both sides are now triple digit, right? This is totally uncharted territory. The Chinese basically stopped the escalation. They said this isn't really meaningful anymore. So we're going to have to find an exit ramp to that, or else that's going to feed through the economy and put a big dent in our macro story.
So on the empty shelves piece,
yes.
When might we see it, and what does that cause in the economy?
Yeah, we're not kind of forecasting that particular one. The stuff that I read that I agree with is probably sometime end of the second quarter. So it's going to be, we're in May right now, so maybe the next couple of months.
And where does that leave your outlook on the economy?
Well, that's kind of factored in already. Let's remember, U.S. is a services economy, so it's 70% services. But certainly we're going to see some stress on the shipment. We're going to see some stress on consumer sentiment. And we're going to have some soft spots before we maybe pull out of this next year. But we got a big descent in growth over the next couple of quarters.
Not surprisingly, the numbers that we got the other day, the GDP numbers, showed a lot of this front loading that we've been talking about, all these companies making purchases prior to the tariffs hitting. I'm slightly concerned that, all this front loading, while it sort of helped last time, it's going to hurt us in the future, right? So purchases made today are not going to be made next quarter. Now, obviously, there are some intricacies there with inventories and things like that. But are you feeling that there might be some interesting negative surprises there too? I mean, consumers as well. Yeah. Front-loaded, but it didn't show up in the numbers. But
yeah, well, there was a funny print, right? Because we had this massive negative contribution from imports, and we didn't really get the full offset on stocking. So there might be a missing hole, but. You're right, the consumer bit, which is what we watched, decelerated a bit in the first quarter. We're going to continue to see that throughout the year. We're thinking maybe you average the first 2 quarters together and maybe some of these one-off things are going to unwind. But the trend is pretty clear. But what we saw in the first quarter was maybe a slightly artificially low number for the US. And we also saw a slightly artificially high number for China because they had the opposite thing where their export boomed. So all this messy stuff around the tariffs is going to take a couple of quarters to sift through. So we shouldn't be focusing too much on one particular data print and kind of looking at the whole, the food chain there.
It does seem like the bond market is hyper-focused on ISM at the moment. We're seeing treasuries paring gains just a touch. To what extent do you think this market is aptly reacting to the stagflationary risks that are presented by so much of the economic data we're getting in right now?
Yeah, well, you've seen that a bit, right? And we know that prices are going to go up. We've got 4% inflation in the U.S. at the end of this year. The question is that just a jump in the price level, or is that really going to start lifting inflation continuously? Longer term inflation sentiments creeped up a bit. But, the bond market's trying to thread that needle, right? So the Fed's probably going to be cautious. We only have 2 cuts this year. The economy's slowing, lots of stuff in the air. So I think the bond market looks like it's reflecting most of that.
And really quick, any thoughts before NFPs tomorrow?
We're watching that. One data point isn't going to change our view, but again, we're expecting a material slowdown in U.S. growth this year, and labor market's going to be part of that story.
Paul, thank you so much. Always a great overview. Really appreciate your time. We're going to have all your markets action ahead here on Yahoo Finance. Stick around. You're watching Catalysts.
Magnificent 7 member Amazon set to report results after the market closed today, Thursday. Given some of the giant historical swings in the stock price after earnings, what is the best way to approach investing in this big tech heavyweight? I'm Jared Blicker, host of Stocks in Translation, and let's get to some charts here. This is a look back of 16 years of what has happened after Amazon reports earnings from 1 day, 1 week, 1 month, 1 quarter, 1 year. Why 16 years? This was starting in the post-global financial crisis recovery, and it's kind of the birth of the AWS era, and so kind of significant there. But what I want to highlight and what you should focus on is that the 1 day, 1 week, and 1 month results are all pretty flat here. They're very volatile. A large move to the upside was often countered by a large move to the downside. Once you get to the 1 quarter level, we see median gains of about 6.35%. And it's positive almost 70% of the time. But that's really not that impressive because Amazon is one of those leaders. You really want to see a percent positive above 70%. So finally, at the 1 year level, we're seeing gains of a median gains of about 32% with 85% positive. Now I want to draw this forward a little bit to the last 2.5 years because that covers 10 periods and basically this entire bull market going back to the fourth quarter of 2022. And you can see things improving here. 1 day still pretty flat, 1 week nothing to write home about, but then things get interesting around 1 month and 1 quarter, and you're going to see 1 year results. Those median results shoot up to over 50%, and we've seen those results higher 100% of the time, although with the caveat that we haven't actually achieved that 1 year price, that 1 year length just yet for some of those the last 2 or 3 quarters. Now I want to get to another chart which shows if you're holding for 1 year, sometimes even that can lose. And this goes all the way back to the beginning of the century. And we can see that holding for 1 year, and this is a blended average of 2.5 returns, only holding for that 1 year period, they hit almost 1% in the wake of the dot-com boom and bust. So that was a recovery. But we saw a dip negative there in the global financial crisis. And then it dipped negative again in 2022. That was that nasty bear market. But you can see it's not uncommon for the 1 year returns to approach 50%, and given the trajectory, we could reach there again. So now I want to go into what we can expect today from earnings based on history. And first, a little definition. Options implied volatility. This measures investors' expectations of future price swings based on options prices, but it does not indicate direction up or down. This is just a measure of how big the swings we expect to be. So tomorrow, today, the options market is pricing in a post-earnings reaction of 6.5%. Now, the average post-earnings announcement reaction over the last 2.5 years has actually been 2 percentage points higher, 8.5%. And this is quite a bit higher than the average daily swings for all the non-earnings days. That's only 2.75%. So I'm going to hold it there. We're going to have to see what happens after the close today. But given the historical price reactions, we could go up, we could go down. The bottom line for investors is that you want to hold for probably a longer period of time. So tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, thank you so much. It's now time for some of today's trending tickers. This morning we're watching NVIDIA, Qualcomm, and Roblox. First up, NVIDIA shares jumping today. They're up a little over 4% last time I was able to check. This comes after CEO Jensen Huang urged the Trump administration to reconsider U.S. rules for exporting AI chips worldwide. Speaking yesterday at a meeting of business leaders at the White House, Huang warned that China is right behind us when it comes to developing AI chips. He also touted NVIDIA's pledge to commit $500 billion to produce chips in the United States, calling on President Trump to increase energy supply to meet the increased AI-related electricity demands. Of course, this move in part because of the increased CapEx listed by both Meta and Microsoft off the back of their earnings. Moving on, though, to Qualcomm. The shares are moving to the downside this morning after the company issued a slightly weaker than expected revenue forecast. The guidance renewing concerns that demand for Qualcomm's chips, which are used in most smartphones, will be lower due to tariffs. Despite those concerns, Qualcomm's chief executive saying it has yet to see any direct impact from the tariffs. And Roblox raising its full-year booking estimates, expecting in-game spending to hold up despite macroeconomic concerns. The company now expecting its annual booking revenue to be between $5.29 billion and $5.36 billion. In the first quarter, the company's daily active users jumped 26% to an all-time high of 98.7 million. Gaming keeping up even amid economic uncertainty. We're going to have all your markets action ahead. Stick around. You're watching Catalysts. Eli Lilly's CEO Dave Rick speaking on the company's earnings call, urging the Trump administration to negotiate deals on tariffs. The comments come after the CEO attended a meeting at the White House and as the company cut its profit outlook, which weighed on shares. Joining me now, Saeed Hussein, Redbrook Advisors managing partner. Saeed, great to speak with you here. To what extent do you think tariff deals are really game-changing for a company like Eli Lilly, particularly given some of the other competition in the space that we are hearing about this morning and that is weighing on the company?
Good morning, and thank you for having me on. Yeah, you're absolutely correct. There are going to be significant issues for pharmaceutical manufacturers such as Eli Lilly with the tariffs. Just like any other industry, these tariffs are going to make it costlier. The kind of difference with the pharmaceutical industry is in the United States, most end consumer cost that's paid by consumers is through payers, right? People have insurance. The insurance actually picks up the cost of pharmaceuticals and people pay copays. When these tariffs potentially hit, those costs predominantly are going to have to be absorbed by companies like Lilly. And that's the bigger challenge is how are these organizations set up to absorb these potential additional costs?
Yeah.
Pharmaceutical manufacturing right now, the way to think about it, it's divided up into kind of two segments, right? There's core, tablets, pills, things like older drugs that are used mostly in the United States, 90% of what's used. And then you have biologics or specialty medications. A lot of this started with COVID. COVID brought the issue of onshoring onto the table, and fortunately, manufacturers had started down that pathway. I think these tariff situation is just prompting them even more so to double down and onshore a lot of this.
So talk to me then, what I'm really interested in this morning is looking at a company like Lilly in comparison to Novo, obviously teaming up with CVS on weight loss drug distribution here. And I wonder to what extent the tariff negotiations really matter for a company like Lilly, given that if there is a tariff applied to this industry, it's going to impact every name in the sector. They're still, at this moment, when you look at the tape, losing, quote unquote, on weight loss drugs. So which one matters more?
I'm sorry, say that again.
So is it weight loss drugs, are weight loss drug issues for the company going to be a bigger issue longer term for investors?
I don't necessarily think so. I think it's broader issues. I think they're trying to still figure out where they are, in the broad sense, right? They have to assess what these potential tariffs could do to them. They have to look to their entire book of products. GLP-1s and weight loss medications are going to be a significant part of that. But I think they have to look at more broadly in the sense of where they're getting APIs, what their negotiation, contracts are regarding, insurance and other things. So it's not just GLP-1s. It's a lot. I do think, to your point, GLP-1s have a big take on a big stake in that decision.
And Mark has a question for you.
Yeah, the EPS growth that we're expecting over the next few quarters is just like fantastical, right? I mean, that's why you see the stocks doing so well prior to today's announcement. The question is the impairment enough on what they discussed today? Is it enough for a stock like this to sell off? I mean, these GLP-1s, they are obviously producing quite a bit of revenue for these companies. Obviously, there's margin there. The better companies like Lilly know how to deal with those, with any of those potential snags. I'm wondering, is this a little bit of an overreaction over here when you see this selling off?
I do agree. I think it is a bit of an overreaction by the market. I think that you really need to wait and see how everything comes in together. GLP-1s, as I said, is one aspect of it, but there's a lot going on. There's this whole issue with the PBMs and how they're going to continue to be playing a role in the segment, and how important they are in terms of drug negotiations. And so I think this is the market just reacting to the news here and having a quick one. But I think we need to take a step back and really see what the broader impact is on everything going on for this company.
Yeah, these GLP-1s looks like they have protection until sometime around 2036. So I think we can be pretty confident that demand seems like it's only growing as the FDA allows it for other types of issues. So what happens? What's your sort of vision into what a company like Lilly, what's next in their pipeline? What would be the next big thing? 2036 seems like a long time, but I'm a long-term investor, so I'm thinking about what happens beyond 2036.
I think, look, right now the GLP-1s are injectable. I think one area is how do we get it into an oral product? That's something that definitely could be an opportunity. But I think other therapeutic categories that continue to grow, for example, oncology, that's another area of growth. And Eli Lilly probably needs to take a step back and think about this, and I'm sure they are, in terms of as this timeline horizons, where else can they go? Is there an extension of this same therapeutic category, or is it going into these other therapeutic categories?
All right, Saeed, thanks so much.
Thank you.
Coming up, potential progress on a trade deal with China. What President Trump's moves in April suggest could be ahead. That's next.
I know that, and I don't want this to happen, but I know that China is doing very poorly right now. I just saw some reports coming out, and I don't want that to happen to China. I like the president a lot, President Xi. I don't want it to happen. I was actually saddened to hear it, but they are getting absolutely hammered in China. But at a certain point, I hope we're going to make a deal with China.
That was President Trump speaking during a cabinet meeting at the White House. The administration has maintained negotiations with China on a potential trade deal, saying they are underway, a claim that Chinese officials have denied. But a Chinese state media affiliated outlet hinting that Beijing may be open to negotiations, writing that U.S. officials have reached out and that there's no harm to China in a potential meeting. Joining us now, Yahoo Finance Washington correspondent Ben Werschel. And Ben, I also want to quickly mention that Claudia Sheinbaum commenting on a conversation that Mexico has had with the president, agreeing to continue working in the coming days on trade. What do we know so far about where negotiations stand, especially with China, given that triple-digit tariff?
For sure, yeah. China's the focus. The focus has turns on China, and what we're looking at this morning are these two blog posts that you kind of have to squint a bit, but are being taken by a lot of Chinese experts as a signal or at least a hint of openness on possible talks down the road. As you mentioned, the kind of formal channels between the Trump White House and Beijing are still engaged in the standoff, but there's quotes in there that suggest an openness. Another one I'll give you is that in these posts is that Beijing sees, quote, little downside in exploring, according to the translation, contact with the United States. So it's being taken as a positive sign, but the larger context here is that both China and both Beijing and Washington are making the case that the other side is what needs a deal more. You know, there was a manufacturing slowdown in China. There's the GDP numbers here in the United States are both evidence from either side that the other one needs to come to the table first. And so the question is who's going to blink there? I would note that these posts, sort of a reality check in these posts, is that some of that language is in those posts. One line in there is that that China has no need to talk to the U.S. again, according to the translations of these posts. So there is a standoff here, but it could be a kind of a smoke signal of sorts on that. The latest from the White House here is that they want to have a deal with China, as you saw in that Trump post, but it's going to be a long process. Stephen Miller, the deputy chief of staff, was asked about the end game for China, and he's talked about how they're still developing a plan there. So it's clearly a long ways away. And as Secretary Scott Bessent says, it's a multi-step process that they're going to go for. So there's some signs here, but it's still going to be a process ahead.
And talk to me, Ben, about the 1 month anniversary of President Trump's so-called Liberation Day coming up tomorrow. Where are we at in terms of the last month and the path forward? I mean, it's fascinating. The NASDAQ 100 is actually up about 1.5% in that time period.
For sure, yeah. I wrote about this morning, a sort of month in review of April. It was, as you mentioned, it was a month ago, Liberation Day, and then April 5th was when these 10% tariffs on the world went in, which is, I don't want to downplay it, it's a historic move that have had far-reaching consequences. But since that April 5th time, I counted 5 significant concessions from Trump, everything from reciprocal tariffs to technology tariffs to auto tariffs to rhetorical shifts on companies as well as China. So it's been kind of a month, at least since April 5th, of pretty significant blinks from the Trump administration in response to the market. And I think that's what to sort of think about for investors going forward, is that Trump clearly has shown in the last month that he's listening to markets, especially bond markets, I would note, and that is, the question is sort of how much that continues in the context of things like these China talks.
All right, Ben, thank you.
Thanks much.
It's time now for our chart of the day. I'm taking a look at how a weaker dollar is actually benefiting companies like Meta. Taking a look at shares of Meta pushing higher here, up over 5.5% after the company did top earnings expectations. Now, a weaker dollar, it might just be Meta's new best friend. It's not just about Meta. A weaker dollar can be good news for any U.S. company that gets a significant amount of revenue from abroad. But looking at Meta specifically, let's unpack why that is. When the U.S. dollar dips, every euro, every pound, every yen that Meta earns overseas suddenly translates into more dollars when they bring it back home, because those currencies are worth more when compared to the declining U.S. dollar. This isn't just a theory, it's showing up in the numbers. Here's what Wedbush Securities Managing Director Scott Devitt told Yahoo Finance.
You know, it's interesting because last quarter when companies reported, the dollar had just completed a period where it strengthened by 4 percentage points. And this quarter into the guides, the dollar had depreciated. So it's a nice offset to this uncertainty of tariffs to be able to guide into that kind of favorable light, especially with Meta having 60% of the revenue coming from outside the U.S.
As you just heard, in the first quarter, over 55% of Meta's total revenue was from international users. Most of that revenue coming from Europe and Asia, a smaller share coming from the rest of the world. And you can see all of that revenue on the screen behind me here. Now, coming up, we dive into the state of the travel industry and the health of the consumer with the CEO of Resort Pass. Stick around for that next on Catalysts. D.A. Davidson raising Airbnb to a buy from neutral on its durable growth trends. Joining us to discuss, the analyst behind the call, Tom White, senior research analyst at D.A. Davidson. Tom, it's great to speak with you. I was live anchoring when your note dropped yesterday, and I was at the same time covering some of the negative earnings prints that we were getting in from some names in the travel sector, the likes of Norwegian, for example. Talk to me about why Airbnb, in your view, bucks this trend that we're starting to suss out this earnings cycle of a little bit of macro weakness weighing on some travel and leisure names.
Yeah, thanks. Look, I think that was the main question we got from investors when we upgraded the stock, was just kind of around timing. And, given a lot of the uncertainty around the impacts of tariffs. Look, I'd say what we like about Airbnb, a few things. One, we're not claiming that leisure travel is going to be immune to a pullback should we have kind of a protracted recession or kind of a downturn. We certainly saw a decline in leisure travel spending during the great financial crisis, which is kind of a data set we looked at closely. Overall leisure travel spending in developed countries was down right around 10% during that period. But if you look at the online travel companies, which is what we cover, those companies were quite resilient. At their back, they had share gains helping them perform better. They had the migration of just bookings from offline channels to online channels. So, during that period, you saw the big companies at that time, like Priceline and Expedia, actually managed to grow each of the major years through the great financial crisis. In Airbnb's case, we think their business is going to prove relatively resilient as well. In alternative accommodations, you're still in the relatively earlier innings of this migration of spending from offline channels to online. In Airbnb's case, also over the last couple of years, they've made a lot of progress addressing affordability on the platform. So they've been able to hold prices on average, generally flat to down slightly, whereas hotels have been up quite a bit. So we think both of those things will help the company perform relatively better. Kind of during this uncertain period.
And Tom, my guest host Mark has a question for you.
Yeah, we like to watch carefully how sensitive consumers are to costs of travel and things like that. And I think we've learned a couple of things that we didn't expect in the past couple of years, which showed that consumers were sort of a little bit more resilient to increases in prices. But that looks like it's starting to change a little bit. You're starting to hear it from the airlines. You see the bookings are down and things like that. Consumers seem like they're getting a little bit more sensitive to prices, especially when it comes to travel. Do you see that trend continuing? And if so, how long will something like that last, assuming that we don't end up in a recession?
Yeah, it's an interesting question. Look, I think, coming out of the pandemic, it was amazing to see how when people prioritized experiences and discretionary spending on experiences over goods, how that really translated into very strong demand for travel. Obviously, that can't last forever if prices go up. But so far, we haven't seen much of a deterioration, at least in the spending trends, again, on these big online platforms. So I think are just benefiting from secular tailwinds around just how consumer behavior is changing. You mentioned some of the airline results and how some of the commentary there has been mixed. With these online travel sites that we cover, we've heard from two so far this week: Booking Holdings a couple of nights ago, and then Trivago last night. Both had very strong quarters, a bit of upside, and talked about April trends being stable versus the first quarter. In Trivago's case, they even raised their full year outlook, which we're not banking on seeing a lot of beat and raise type quarters out of our travel-based companies, but so far, we're not seeing much alarm. That said, we and a lot of other analysts on the street covering the space are sort of proactively cutting estimates for the back half of this year and next year, just to be cautious.
All right, Tom, got to leave it there. Great to get your thoughts on the call. Thank you so much. Let's stick here with travel demand. Macro uncertainty for hotel chains, something flagged by analysts for both Hilton and Hyatt results this week. Airlines have also warned of economic uncertainty around demand. That's where the staycation comes in, with one company benefiting from the boom. Joining us now, we got Michael Wolf, the CEO of Resort Pass. Michael, thank you for coming in the studio. Really appreciate it. For anyone not familiar, Resort Pass, you basically have the opportunity to get a day pass to a pool or a spa at a hotel. Talk to me about you. Like, who's your consumer? What's their income like? And how are they holding up right now?
Yeah, so we enable day access for hospitality. So you're not staying overnight at the hotel, but you can use the amenities, things like pools, cabanas, spa, fitness, wellness, even the rooms just for the day. And the reality is that our customer is everyone. Because we have hotels that are some of the most luxurious hotels in the world, 5-star hotels, but we also work with more accessible hotels. We work with over 2,000 hotels, so it's really a little bit of everyone. And we're seeing a lot more excitement about the category because as per the hotel earnings being down and long-haul travel being a little bit on the decline, we're seeing a lot more people wanting to kind of vacation locally. And that's really the rise of the daycation as part of that.
And I've been wondering if your success is sort of an indicator of any macro uncertainty, a potential recession indicator even. Skip the vacation, do the Resort Pass. Are you concerned at all that a broader, deeper economic slowdown could weigh on your business?
I actually think it'll ultimately help because I think people want these experiences. They want these moments of recharge, but they're a little less likely to get on a long-haul flight over to Europe right now. But they still want that same experience. So when we've surveyed our users, 85% of people feel that idea of a vacation brain just from a single day off. And so I think people still want that feeling of a vacation, but a little bit closer home, and that's what we provide.
Yes, so much interest. I mean, I've seen a lot of this stuff online, and we were just talking about that, and it looks like some really interesting stuff. A lot of great growth potential opportunity. All these macro factors are certainly working in your favor. So from your perspective, what's next for the company? Where do you go from here?
Yeah, I mean, the reality is that most people don't even know this exists. So we've created an entire category, an entire movement, really. You know, the hotel industry is really focused on ancillary revenue right now, and that's exactly what we hit. But the difference is compared to the aviation industry, which has, done, I think, a pretty good job of ancillary revenue and charging for every square inch of an airplane, is that users aren't always happy about that. Customers who are flying aren't. Whereas in our case, the hotels benefit from the incremental revenue and the large amount of food and beverage we drive, but it's also an incredible experience for the guest. Right? So we're ancillary revenue that benefits both the supply side, the hotels, as well as the guests. And I think we're truly just getting started. We work with 2,000 hotels. We're adding 100 hotels to the platform every single month. And still, most people don't know we exist, even though we've tripled the size of the business in the last 2 years.
To Mark's point, though, it is interesting to think about how you scale when I don't necessarily see a very wealthy consumer opting for this. It's a drop in the bucket to pay for the hotel room for the night. Why not just do that?
I think in many cases, it's actually a very wealthy customer. It's just that they live down the block. So, I've done this obviously many times here in New York, and we work with some of the most prestigious hotels, 5-star hotels. They might be $1,200 a night. I could afford that. I just don't necessarily need that because I have my own apartment in New York.
Yeah.
But I still want to use the experiences of the hotel.
So who's your competitor then? Is it the likes of a Soho House comes to mind? We were just talking about Airbnb. Is Airbnb a potential competitor?
Airbnb actually is a really interesting complement because we focus right now in this conversation on the local use case, but a lot of our use case is actually people traveling, people spending $20,000 a week on an Airbnb in Miami, let's say, but what do they want to complement that with? For a day or two of their vacation, they want hotel amenities. Or maybe they're checking out of that Airbnb. Every single day, millions of people check out of Airbnbs, usually at 11 a.m. Their flight out might not be till 9 p.m. at night. Where do they go? So now they get to benefit and have an additional day of their vacation. So I think we're actually quite a bit of a complement. And again, what's very unique in the hospitality world is that we're relevant locally, which is almost unheard of in hospitality, but we're also relevant again when you travel.
And they don't go to their Soho House where they have a membership and they exist in so many cities around the world?
Yeah, I mean, I think members clubs are great, but that's servicing a very, very small percentage of the addressable universe, even people with high discretionary income, and that's where we come in. Like I said, we work with companies like Ritz-Carlton, Four Seasons, Auberge, the one hotel in Miami.
Interesting. Again, back to the competition. I could see a world where hotels would want to compete themselves, right? To obviously fill those to recoup some of those big expenses they spend on building out their beautiful facilities. How do you see that possibly impacting your outlook?
Yeah, well, the reality is a hotel's core business is filling up overnight rooms with travelers. Our core business is filling up all the other spaces of a hotel with locals. It's a really different business. It's a really different target customer. It's a really different motion. Hotels have to focus on RevPAR and occupancy, and that's their core business, and they're great at that, but they've never really thought about the rest of the surfaces of the hotel. You know, what I always think about is revenue management and yield management, the core of a hotel. They're so smart when it comes to their room product. They've never applied those same lessons to the rest of the surfaces of the hotel.
All right, Michael, we got to leave it there, but really great overview and super interesting read on the consumer. Thank you so much. Really appreciate your time this morning. Also, huge thanks to Mark Malik for joining me for the hour. Always appreciate your insights, Mark. Thank you for being here. Before we head to break, I want to check in on the major averages here, especially given the success we've seen over the course of the day when it comes to big tech. Take a look at these moves. NVIDIA up over 4%. Microsoft ripping off the back of that cloud revenue beat. It's up over 9%. You've got Meta up off the back of their results as well. That company up over 6%, and that is leading to gains across the major averages as well. Coming up, we've got wealth. Stick around for more.